Well, we're going to talk today about who your professional advisors are, and you're part of a team, and your advisors are part of a team, and that's really important. We will hit on the nuts and bolts of taxes and tax season being upon us right now, things you might want to think about. Also, how tax preparation is more than just compliance. Yes, you need to have a tax return prepared, but what we as accounting advisors and tax advisors look to do is really help you focus on options, alternatives, and planning for both now and the future. And we'll talk a little bit about some of that. So, who are your professional advisors? Well, your doctors. Uh, you likely have a general practitioner, a GP, or an internist, um, maybe a cardiologist, gastroenterologist, OBGYN. Um, these doctors may not directly talk with each other, but I find in my case that since most of my doctors were referred to me from my internist, they already know each other because they're affiliated with the same hospital, and I like that. And they do talk to each other. GPs now are required to keep detailed databases of information. This, I think, is a new federal law, which maybe you've noticed. The doctor spends half the visit typing in to uh, um, to his software details of his conversation with you and facts, and then you might get an email later. Um, this is great. So the doctors are able to interface with each other. Um, Lawyers, you may or may not need a lawyer in your life. Maybe you don't get involved in any business transactions. Maybe you've never purchased real estate. Um, Hopefully, if you have matrimonial issues, they're good ones, and you don't need a matrimonial attorney, but that may happen. Um, and maybe you're getting to that age where you need to create a will and plan for your future estate. If you have enough assets, you may be creating trusts for people, kids, or others who you look to leave money to. Um, Bankers might have a regular banker who is your private banker for your personal matters, maybe someone else to handle your mortgage, home equity loans, and other loans. In the insurance world, um, depending on whether you just need insurance coverage, let's say for your contents and for general liability, you may be self-employed and need certain coverage. You may have hired household help. You want to have certain coverage there. Financial advisors, more than a broker these days. And really the crux of what we're going to talk about today is going to be the interaction between your accountant and your financial advisor, but it also applies to the attorney. Like if you are creating an estate, um, a will for your estate, the attorney should be in discussion with the accountant because there may be things the accountant knows the attorney doesn't know that you're not aware of. And your accountant is first and foremost getting your tax returns done so you can be compliant with the law. But we give a variety of financial advice that has nothing to do with investments. Some accountants get involved in investments. It's not my area, but I like to know what your investment advisor is talking to you about so I can give my input there. We're business advisors. We help you as accountants plan for, again, a corporation, a business that you're looking to build and grow. Maybe it's a small self-employed business that you just need advice beyond taxes on, and you have nobody else to talk to. Talk to your accountant. And of course, retirement planning and estate planning. Um, so the important way to look at your professionals that you work with is that they should be part of a team, which you're a major part of. It's very easy for us to go to an advisor, tell them what we need, count on them to do the planning for us, trust what they come up with, and trust is a really good thing. But I think as a willing participant, you really want to become as knowledgeable as you can so you at least know the right questions to ask. You should become part of the process. Yes, it's easy to just hand over the information, but developing trust, I think, works best when you not only trust your advisor, but the advisor trusts you to give them the right amount and quality of information. Um, Also, it's important for you to make sure that your advisors are proactive and aren't just handling things when you call and ask them to. Do they speak to each other? When do they need to speak to each other? I'll give you an example, and that's what I'm going to do. I'm going to throw out little examples, and maybe this applies to you, but maybe it doesn't. But I have a particular client who went to a new financial advisor, and he calls me in the beginning of January, and he says, "You know, my advisor had me sell off all these stocks in December." I said, "Really? Let me see what you're talking about." Now, we never in the past, this client and I, needed to do any year-end planning because his world was fairly straightforward. Well, the advisor had him sell off stocks to the tune of a $350,000 profit that is going to be taxable for the year that just ended. And if I had known that, we could have done some planning to prepay some state taxes, as an example. We may have talked about shifting some of those gains to take losses against them instead of waiting to take losses later. The advisor was not thinking about the tax effect here. And it could have been very beneficial if the client knew the kinds of things that the financial advisor should be aware of in terms of tax planning, had been in discussion with me, and we could have saved a lot of money. Meanwhile, 2 years later, we're now on course to make sure we go over these things before decisions are made without enough information. Another thing about financial advisors, when there's a retirement plan, and this is just kind of a one-off, how do they charge their fees? Very often, they will create a charge to the account and reduce some of the assets to pay the fee to manage the account. Well, if it's a business retirement plan, um, you have the ability, if you're invoiced separately, to have the fee paid by the business and get an additional retirement contribution and not lose the assets that are in there. That's something that the advisor is not going to think about, but in discussion with your accountant, you may learn this. I don't expect you to remember it, but again, in decision making, utilize your professionals, ask the questions, and certainly, I'm I'm pushing for myself as the accountant to be the one who touches all these areas. You should reach out to your accountant. Um, any questions at this point? Okay, the time I see goes very quickly. Let's just talk about some of the nuts and bolts of taxes. I don't know how aware any of you are about preparing tax returns, whether you do your own returns, whether you have an accountant prepare them, whether you're in a relationship, married, where your spouse has the returns prepared for you. Very often it is just one person in the marriage that does that. But just to inform you, so there's various due dates and deadlines. There's been a change where in the past all corporations were due March 15th. Now regular corporations, C Corps, are due April 15th. Partnerships were always due April 15th. Now they're due March 15th. C Corps are due April 15th. However, C Corp could be due April 15th, but it still has to pay its New York State and city taxes by March 15th. This is creating a real problem for planning on our parts as accountants. But just be aware that there's been a change in due dates if you do have businesses, if you're involved in partnerships and the like. Personal tax returns have been due April 15th for a long time. You can extend the time to file until October 15th, but not the time to pay. So if you are not going to be able to get your tax return filed by April 15th because you're waiting for information from third parties, or even getting investment information, what's happening, as you may have noticed, if you have a investment advisor and you receive what they call a consolidated 1099 at the end of the year, very often you'll get a second version of that, and sometimes a third that doesn't arrive even till the end of March or April. And the reason for this is the underlying securities that are held in the account, often the tax effect of dividends and transactions within those individual securities are not fully vetted and evaluated by the company. So your broker doesn't find out until later that there's a different way to treat it. But so be aware that you still have to estimate or pay an estimated amount of taxes by April 15th. Estimates, if your earnings are not subject to withholding, as in a salaried position, but you're either self-employed or you have substantial earnings from investments. You have estimated due dates, April 15th, June 15th, September 15th, and January 15th. It sometimes is advantageous to prepay any state or local taxes you owe by December 31st, because those are an itemized deduction and deductible for the year that they're paid. Because of something called AMT, the alternative minimum tax, which hits a lot of people who are upper middle class and higher in earnings, it may not be advantageous to prepay, but this is something to discuss with your accounting advisor. Things like sale of a home or sale of property. So I have another client. He didn't tell me until after the year ended that he sold his house. Well, it was his second home, but it was also a home that he had bought for $150,000 many, many years ago out in the Hamptons. And now, you can probably guess it was worth $7 million. Huge profit, big tax to be paid. Now, the tax is not due till April 15th, but the state and local taxes should have been prepaid before the year ended, and it would have saved him an enormous amount of federal tax, of which he's never going to get the benefit of, because when he pays those state and local taxes by April 15th, there won't be enough income in this current year to take advantage of all that. And so that's something that's not just a timing issue, but there we lost about $250,000 in saved federal taxes. Good to have the discussion. Call your advisor, whoever it is. In this case, I'm talking about the accountant. Good to be proactive yourself and also ensure that your advisors are proactive with you. Some of the things that you also need to be aware of, if you have any foreign investments, if you have $10,000 or more in a foreign account, you may have to report that on a form that used to be called an FBAR. If you received a gift from a foreign person, you may have to report that on a particular form. The penalties for not filing those forms, and they're only disclosure forms, but the penalties are substantial. So really what's important in doing your taxes is making sure that the information is all captured. It's all presented as timely as possible to your accountant. Most of it is after the year has ended, but many things can be done before the year ends. Things to be discussed, where you live, where you work, is there a weekend home? If you're a New York State resident, as I'm assuming many of you are, there's information asked on the face of a New York State return now. In fact, the date of birth has to go there. Do you have living quarters? Do you maintain living quarters in New York City? Answer yes or no. You may not be living here, but if you have quarters here, then any day you spend in the city can make you a resident of the city, and that's something that needs to be looked at. Maybe you can do some planning to make sure this works out in a more tax efficient way. So preparing of income tax returns, it's not just compliance that's important, because sometimes there's more than one way to do things. We've talked about on the income side, knowing that there is income for a period. You might want to defer income until the next year if you have an opportunity, for a variety of reasons. Maybe you'll have substantial expenses in the next year, or maybe you had substantial expenses this year that by accelerating the income, it would be more worthwhile. Residency issues, knowing that you're going to be moving, thinking about moving. This is a discussion that you should have with your accountant sooner than later. 529 plan. If any of you are putting money away for college for your kids, 529 plan is a way to put money into an account that can have earnings that are tax-free and can be withdrawn when needed for school. Be careful, though, that if you live in New York State and you want to get a tax deduction for up to $10,000 a year for payments into the plan, it has to be a New York State 529 plan. I just ran into a situation with a new client who sent their information about the 529 plan. I looked at the past tax returns and I saw that she took a deduction for these plans. But then I looked at the form that came and I saw that it was not a New York plan. I contacted the investment advisor. It was not a New York State plan. Just going to have to pay some back taxes to get that cleaned up because notices have just started to come in. Some of the other things to think about going forward to 2017 really involves how your financial advisor handles your investment accounts, but things that an accountant would think about for a tax benefit. Sheltering dividends in retirement accounts. If you have dividend producing investments that can be put into a retirement account, that would be a better place to put them than, say, municipal bonds where the interest is exempt, where if you hold those personally, you're not going to pay tax on the income anyway. Consider selling off assets for losses earlier in the year so you have the money available to invest so it can be earning its investment dollars over the course of the year rather than just at the end of the year. Same with contributing earlier to a retirement account. Over the long haul, this can save you quite a bit. Same with Roth conversions. Consider them earlier in the year to increase the number of months of tax-free growth. And consider rebalancing your portfolio to be more tax efficient in discussion with your financial advisor who's looking for the best investment opportunities, of course, which makes sense. Any questions at this point? I see how fast the time goes when we're having fun, so we're going to move a little more quickly so we can get through this, and then you can ask questions if you have. There are a variety of pre-tax opportunities, whether you are a salaried employee or whether you run your own company or self-employed. There's health insurance accounts, flexible spending accounts for things like dependent care, medical expenses, health insurance. Ask at the place you work to see whether these exist. If they do, you can put money into these accounts that are pre-tax so that you can use them when necessary, where personally you wouldn't get a deduction for those items. You might get a benefit through your employment. If you're self-employed or you have your own company, talk to your advisor, your accounting advisor on this. Transit check, it's become very popular. It's very useful. You can receive up to a certain amount each month, again, pre-tax. 401ks, look to see if you can increase the amount you contribute even after the year has ended. Many companies allow that where you have up until the due date of the filing of a tax return with which to make the contribution. And maybe there's an employee match there. Just a few items to touch on to plan further for now and for the future. Estate planning. Do you have a will? I don't know what your age is. If you're 25 years old, you don't really need a will yet, but it's something to consider. Ask your accountant what your accountant thinks before you even go to a trust and estates attorney. There's different rules about annual and lifetime gifting. If you have enough assets and wherewithal that you would like to give gifts, there is a slide that follows this that has some of the rules. For example, you can gift up to $14,000 per year per person, and it's not subject to gift tax. It's not reportable anywhere. So you and your spouse could give up to $28,000 to any one person, whether it's a child, a nephew, or the like. If you're going to run into a gift tax problem, and you have a child, say, attending higher education, a grandparent may want to pay for college. They should pay directly to the college, not give the money to you, who then pays to the college. That's a way to avoid the gift tax consequences. We talked about 529 plans for a moment, matrimonial matters. Um, don't automatically let your spouse file your tax return for you. Know what's going on. Yes, you can trust them, but it's a good idea to know what's going on, because then if things don't work out in your relationship and you don't know what happened in the past, you can have a problem. Um, if things are not working out and you are either separated, planning for divorce, or maybe not, consider married filing joint versus married filing separately. The first is usually lower taxes, but the second might be worthwhile in terms of protecting you if your spouse is doing things that could cause a problem later. Again, it's a discussion to be had with both your matrimonial attorney and your accountant. Alimony versus child support. Alimony payments received are taxable income to you. They're deductible by the spouse that makes them. Child support is not taxable income and not deductible by the spouse who gives them. So obviously, if you're going to be the receiver of money in a settlement, you'd rather get child support than alimony. Um, so anyway, another situation where your professionals should interface. Um, any questions at this point? I think we have a few more minutes. Um, on your own, look at the slide here. This actually comes from the IRS website. It's a good summary of some of the rules relating to gifts. Retirement planning, I'm not going to spend much time on, but know that there's a variety of options. An IRA is the most traditional type of investment. If you don't have any other retirement plan, you can put $5,500 into an IRA, or $6,500 if you're over 50 years old. This might be limited or non-deductible based on the income or coverage that you have under another plan. If you do, a Roth IRA is an interesting idea. It's a non-deductible IRA, but the earnings in there become tax-free when you when you withdraw the assets later on. You could also convert a traditional IRA to a Roth, which can be beneficial in a low income year, because what happens is the IRA that you are withdrawing and converting to the Roth will become taxable, but then the earnings on it later on will not be. If you're in a low income year, it's a good opportunity to do some planning there. On the next slide, there is some discussion about IRAs and Roth IRAs and things that you can do. And I feel like we're just getting going here, but we're at the end of the presentation, and I hope everybody learned one or two things that could be helpful, or at least it got you thinking about the kinds of ways that you should be working with your professionals and some opportunities to save you taxes. Feel free to send me an email or call. Email is best. If you have any questions of any sort that I could be helpful with, I'd be very happy to offer my thoughts.
Thanks, Peter. And we did just have a question come in,
Sure.
and I'll remind everyone, if you have a question now, you can use the chat or email info@savvyladies.org. The question we have is there any way I can use a 1031 exchange to save on real estate taxes? I purchased a condo in New York City 20 years ago and would like to limit my tax burden when I retire and move out of New York City.
1031 exchange is a wonderful thing. 1031 stands for the Internal Revenue Code section, which allows for the deferral of gain in a like kind exchange. What that means is you're looking to give up one asset and you're going to acquire another asset that's similar. Real estate has a lot of flexibility in what determines a like kind. The one thing that you can't do is you can't give up a primary residence in a like kind exchange, it's got to be investment or business property. It won't work on the primary residence side. However, if and you have to be careful because you get an exclusion if you sell your primary residence of $250,000 or $500,000 if you are married, filing jointly. It may be more advantageous to sell it, take the gain, pay tax in order to get that exclusion. But if not, and it's a primary residence, you can maybe get out of it being your primary residence. And there's some rules there, but that's a possibility because if you do a 1031 exchange and you move out of the state, you're going to be able to possibly not have to pay tax in the state that you were living in. Now, you're almost always going to have to pay tax in the state where the property is situs. So if it's a New York State piece of real estate and you move out of New York State and you do a 1031 exchange, when you eventually give up the property, you're still going to have to pay tax in New York State. But if you'd like some more thinking on this, please get in touch with me. I'd be happy to talk to you about it.
Okay, thank you. And another question we have for you is, if I was thinking about starting a small business, what would be the criteria for starting it as an LLC as opposed to incorporating?
Okay, so I'll just give you a couple of little pieces of information. An LLC is a limited liability company, and it is formed under state law. And basically, if you take what we'll call a sole proprietorship or a self-employed business, that's just you, and you turn that into an LLC, that's still just you, for income tax purposes, there's no benefit. It's what's called a disregarded entity. But for liability purposes, you could be protected. So I advise many of my clients who have self-employed businesses to form an LLC, and they'll be protected against being sued in the normal course of business. However, you may want something beyond just a limited liability, and maybe you don't want the details of your business showing up on your personal return, or maybe you also want to do some more sophisticated retirement planning. So a corporation could be the answer there. There's what's called a regular corporation, a C corporation, or an S corporation. An S corporation is very typical where it's a closely held business, meaning you're running it and controlling it, and you don't want to pay corporate taxes at the end of the year. So an S corporation flows through the profit or loss to your personal return, but it's a separate legal entity. There's many more pros and cons between LLCs and corporations, which we unfortunately don't have enough time to discuss. But every situation has to be looked at because they're all different.
Okay, thanks. Another question for you is, once I set up and start contributing to a Roth IRA, do I need to contribute to it every year?
No, contribute whenever you want. No requirement. You could do it once. That's it.
Okay, thank you. And I think this is the last question we have for you, which it's, I've been trying to do my taxes on my own. What's the average cost instead of using an accountant to do your taxes if you're a single professional with one property?
Well, interesting. I'm not quite sure. H&R Block, which I'm sure you're all familiar with just from seeing their storefronts. Sometimes they're there all year round. Sometimes they just pop up during tax time. Or a solo practitioner who doesn't have much overhead, but is just as competent as an accountant at a larger firm. Probably going to cost you $500, if not more. I don't think in New York City you can get it done for much less. It could be $700. And then it's going to work its way up from that. Many small to mid-size accounting firms have minimums of $1,000 to $1,500. So it could be anywhere from, and I understand if you've been doing your own taxes, to have to pay $1,500 is a scary thought and may not be necessary. but it could be, you know, in that range. But I think you should be able to get H&R Block or a storefront or a solo accountant to do your taxes for certainly under $700.
Okay, good to know. All right, well, those are all the questions we have for now. So I want to thank you, Peter, for presenting today, and thanks to everyone who joined us and asked questions. We hope that you'll be joining us again. Thanks so much, Peter. It was really
My
great.
pleasure. Absolutely. Thanks
Thank
for
you.
taking part.
Bye-bye.
Take care.